Hi, everyone. I'm Amish Mehta, partner and nonprofit practice leader at Friedman LLP. Thank you for tuning into our seminar today, the webinar on navigating significant changes in financial reporting, keys to drive your mission success. Joining me today are partner Denise McKnight and director Patrick Dugan. Whether you're well into implementing the process or just getting started, this webinar will give you valuable information as you move forward under the new nonprofit financial reporting standards. Today, we'll be walking you through the major changes and implementation updates since the standards release, as well as critical guidance regarding the new accounting standard for contributions received and made, and details on new recognition, which is the ASC 606, the revenue from contracts with customers, as well as leases, which is ASC 842. We'll look at those standards and the impact to your respective organization. Throughout the presentation, please type any questions that you have into the chat box. We'll answer your questions at the end of the webinar. Of course, if you have any further questions or concerns, you can always contact your Friedman advisor, Patrick, Denise, or me. We know many of you listening today are clients and friends of the firm. For those of you who aren't familiar with Friedman LLP, we're a mid-sized accounting and advisory firm headquartered in Manhattan with locations throughout New Jersey, Long Island, Philadelphia, and China. We've been serving the accounting, tax, and business consulting needs of public and private companies since 1924. Our nonprofit practice supports more than 200 clients, both large and small, that focus on an array of issues ranging from social advocacy to human services to the arts and more. Our goal, quite simply, is to empower you with the highest level of technical expertise and consulting services. Again, thank you for joining us today. We have a lot of material to cover, so we'll start by turning it over to Denise McKnight, who will start the presentation with the nonprofit financial reporting presentation standard.
Hello, everyone. We're going to start out our presentation today talking about the not-for-profit reporting standards. All calendar year entities have already adopted this pronouncement. My plan for today is to review the implementation struggles that organizations had, how the organizations and the boards felt about these changes, and really just give you some feedback that we heard from the implementation with our clients. So just to remind everybody the purpose of the revision, right? They wanted, the FASB, when they did this, they wanted to eliminate complexities and confusions that not-for-profits were having in their financial reporting. They wanted to show more transparency over liquidity. And they wanted to have some consistency in the presentation of expenses. So let's see if the FASB accomplished its goals. Let's talk about some of the changes and the feedback that we saw. So one of the big changes was the simplification of net asset classes. So originally it was unrestricted net assets and temporarily restricted net assets and permanently restricted net assets. Now you have your classes of with donor restrictions and without donor restrictions. The feedback was that people really liked the cleaner presentation on the financial statements. Instead of having multiple line items in the net asset section, we now have two very concise line items with a clear description, with donor restrictions, without donor restrictions. Now, remember, these are just names and categories. It doesn't change that there are restrictions that come along with donor monies. And so one of the dialogue points that we found a lot was we have these two net asset classes now, but there are always, of course, subcategories underneath them. And without donor restrictions comes the board designated net asset classification. And there was much dialogue regarding how much of that without donor restriction net asset class was designated by the board for a specific purpose. So that actually created really good dialogue between management and the board in looking at those two net asset classifications. The next change I wanted to point out was a reminder on reporting expenses by nature and function. So voluntary health and welfare organizations were always required to have a statement of functional expenses. Under the new reporting guidelines, now all organizations need to show somewhere expenses by nature and by function. It can be a new statement, it can be on the statement of activities itself, or it can be in a footnote. In addition, organizations have enhanced financial statement footnote disclosures regarding the methodology of how expenses are allocated between management in general, program, and fundraising. The feedback that we saw in the implementation struggles was that management really needed to get a better understanding if they were consistently applying what they thought was their allocation methodology. The footnote disclosure goes so deep as to say that certain allocable expenses are based on headcount or based on salaries or based on square footage, and is that consistently applied? So we saw a lot more internal looking at this, which is phenomenal. It really will give the organization much better information with regard to where they're spending their money, how they're spending their money. Now, what the boards are looking at is they're getting this information if this is the first time they've seen it, and are looking at the expenditures that go along with a specific program and determining, is this a program that we as an organization want to continue with? Is it viable based on the revenue stream, the support that the organization is able to get to offset those expenditures? Lastly, what we were hearing from our clients is it wasn't overly burdensome to put this together. If they weren't a voluntary health and welfare organization, they were still an organization that was required to file a 990, so they had the starting base to create this information. Statement of cash flows is another change. This was specifically just related to organizations who use the direct method in reporting their statement of cash flows. The feedback that we had, there's not a lot of organizations that we saw that use the direct method of cash flow reporting, and so for those that do, they found this just to be a simplification of the statement. The change, this is the one change that is an actual change in accounting and not just a change in financial reporting that comes from this new guidance. Donated long-lived assets. So under the old GAAP rules, if a organization received either a donated long-lived asset, such as a building, or money to be able to buy a long-lived asset, such as a building, the organization could choose to release that restriction to match the depreciation for each year. Under this new standard, that is no longer an option. So the funds received or the donated asset must be released to net assets without donor restriction as soon as the expenditure is made. So this actually requires a restatement of beginning net assets to make that release of that unreleased depreciation expense at the implementation date. Requires management to take a look at what is in temporarily restricted and make sure that there are no expenditures like that which need to be released. And it actually creates a lot of education. That's a restatement, which means they need to explain to the users of the financial statements why they're restating their net assets. In addition, now that column that is net assets without donor restriction, which when we take a look at those statements, it's really where operations is focused on. Now, all of a sudden, it may look like a loss is being generated because depreciation expense is coming through there, but there's no offsetting at the top of the support and revenue section, a reclassification for that restriction. So now you have a higher beginning net asset balance that you're going to eat into every year for depreciation expense. So that took some education at the management level, at the board level, and of course at the outside user of the financial statements. So this was a tricky one, so keep that in mind if you haven't yet implemented this standard. So now that really talks about the changes in the actual financial statements. Because of that simplification methodology, there's a lot more disclosure that needs to be within the financial statements. So what we're going to do briefly here is I'm going to go through a couple slides pointing out some of the new disclosures and the challenges that came along with that. So in the beginning, I talked about now the changes in net asset classifications with donor restrictions, without donor restrictions. There now needs to be a footnote that gives the reader more information about what that means. That line item that says net assets with donor restrictions, what exactly are the donor restrictions? So the footnote really looks like it has what are the net assets with donor restrictions for program, with donor restrictions for time, with donor restrictions in perpetuity, with donor restrictions inside an endowment, outside an endowment. It it can be as much information as the organization wants, but at least has to have those categories so that the outside reader understands what the restriction is that needs to be met. In addition, if you have self-imposed limits such as board designations, this disclosure is where you would disclose what those board designations are. The feedback that we got from this is because there's so much information in this footnote, it allows both management and the board to sit back and look at what really comprises that restricted net asset category and making sure that they're utilizing those funds. The donor gave the funds with the restriction for the restriction to be met at some point, not for this net asset just to continue to grow. So it really brought to the forefront to remind the organizations to use the funds for their purpose. The liquidity disclosure. So this is a brand new disclosure coming from this pronouncement that really wanted the organization to focus on telling the reader what liquid resources were available or will be available to meet the cash needs of the organization in the upcoming year. And they want qualitative and quantitative information. And so the chart really looks at starting with your financial assets that are available for use, and then backs out what restrictions might be put against those financial assets to come up with this ending number of liquid assets available for use in the next year. Based on what that answer is, in addition to the chart, is you're going to explain what other assets might be available for use during the course of the year, such as availability of a line of credit, the availability of board designated net assets if necessary. But you'll also disclose if there are financial assets that have restrictions such as restricted cash, loan covenants which require that you only have a certain amount of time. So the feedback that we received from this is that it was really interesting exercise to take a look at this and calculate out what the available net assets, available financial assets are. In talking to the boards, what they really appreciated this because even non-financial board members could take a look at this and say, okay, so this is our available financial assets and how much our expenditures for the year, what is our cash flow turnover look like? And so it's been a really useful exercise for organizations. Endowment disclosures. So there's a new disclosure related to underwater endowments, meaning endowments that might have started out at $1 amount, but due to the investment policy might have eaten into its principal. For organizations that have endowments, the challenge has been that endowments have lasted, 40, 50, hundreds of years, and they may not have that original gift amount. So that's really been a challenge to organizations. But what it has shown is it's really reminding organizations to always continue to reevaluate their investment policy. So in conclusion, what I wanted to just give you there was sort of what organizations and boards thought of the changes for those entities, 1231 calendar year entities that have already implemented this. If you would like to look at the details really behind what the presentation in the financial statements needs to look at, what the footnotes need to look at, we do have the previous webinar that we presented last year available on our website, or please feel free to reach out to us at any point. I am now going to pass the baton over to Pat Dugan. He's going to discuss with you the new revenue recognition standards and the new lease standards.
Thank you, Denise. Hello, everyone. Certainly a lot of good information there to reflect on in Denise's presentation. So as Denise mentioned, my talk is going to cover the new standards on revenue recognition and lease standards. The revenue recognition we refer to as ASC 606, ASC being Accounting Standards Codification as developed by the Financial Accounting Standards Board. So these topics together probably are maybe 6 to 8 hours of content. However, we're going to try to distill some of the key concepts in 15 minutes. The idea is not to have you walk away with the full knowledge of these pronouncements, but just to hopefully maybe remind you, if you're already somewhat familiar, but definitely to kind of kickstart and maybe get you started on the process as we're closing in on the implementation deadlines. So ASC 606, the original pronouncement came out in May 2014. So the FASB intentionally provided a long runway of 5 to 6 years for implementation, and then implementation is here. So if you are a non-public entity, the implementation of the new revenue recognition will be effective for calendar year December 31st, 2019. If you are a fiscal year end, say June, it'll be June 30th, 2020. To the extent you are a nonprofit organization that has what we call conduit debt, which really means that you have bond financing, say revenue bonds that were issued by a government entity, you may be considered to be a public entity. And if you are subject to implementation earlier, which would have been for calendar year December 31st, 2018, or perhaps upcoming June 30th, 2019. So the scope of the new revenue recognition standard essentially encompasses all revenue streams and all contract types, except for, as you see in the last bullet point on the slide, it does not pertain to not-for-profit organizations that receive contributions. Later on, Amish is going to cover the new updated standard relates to discerning the difference between contributions and exchange transactions, which will dovetail into this ASC 606 implementation. And not by coincidence, they both have the same implementation dates. So contributions will be outside the scope of what I'll talk about today, and also maybe somewhat obvious, but just to mention that any investment-related income also is not within the scope of ASC 606. ASC 606 is really built on the foundation of what we call 5 elements, or the 5-step process, which you may have heard of. On the slide here are the 5 elements. That's going to be the majority of what I talk about at a very high level. So you can maybe get an idea of what you need to think about in your own organization for beginning the implementation process. Step 1 of the process is identifying the contract with the customer. A contract is an agreement with enforceable rights and obligations. It could be written, it can be oral, or it can be based on standard business practices. You can see there's a number of bubbles there with some different criteria. I think, certainly they're all important. I think 2 of the more important ones are the last 2 with regard to commercial substance, and the collectability must be probable. So you always, more important in this standard, say than prior standards, is the idea of there must be commercial substance to the transaction. Also different from existing revenue recognition guidance is that at the inception of the transaction, you're required to assess whether collectability is probable. So that is definitely a new concept, and it may or may not, create challenges for you in the organization. I think that there's probably more challenges with this in the commercial sector, but it's possible that there's some challenges in the nonprofit sector as well. The second step in the 5-step process relates to identifying performance obligations. This idea of performance obligations is also a new concept in ASC 606, not something we've had to think about before. The performance obligation is simply a promise to transfer goods or services, and it may be explicit or implicit in the contract. Where this becomes more difficult is, for example, in a membership situation, if your organization has members and provides memberships, say annual memberships, we'll use an example of a museum that's providing, say, an annual membership to the museum. May seem pretty straightforward, but under the new revenue guidance, you're going to be asked to think about that a little bit differently. For example, in that membership, there may be multiple performance obligations. For example, you're granting access to the museum during the hours of which the museum is open. You also may be offering a newsletter, maybe quarterly or monthly. So it could be a second performance obligation. And then thirdly, you may be offering another perk, for example, a parking voucher or free parking in a local garage if you're in the city. So therein, you potentially have 3 performance obligations, which you will need to think about for revenue recognition, which is quite different than the way you may be handling it today. So again, assessing performance obligations may present some challenges. It certainly has presented challenges in the private sector. or I said the commercial sector, and implementation for public companies at December 31st, 2018. There also may be some judgments involved in that process. Third step in the 5-step model is determining the transaction price. The transaction price is the amount of consideration that the organization expects to receive in exchange for goods or services. One of the potentially challenging components of transaction price relates to variable consideration. This may not be as much of a factor in the not-for-profit industry as it is in commercial enterprises, but to the extent that you have transactions or contracts that do not provide for fixed consideration, you will need to consider it as a variable consideration component. And what the standard asks you to do is to kind of project forward and kind of give your best estimate of what you think the ultimate amount of consideration is that you will collect. So again, if there's no variability in your transactions or contracts, it's not something you have to think about. But if you do have variability in what you might receive in the transaction, then it's something you should focus on. The fourth step in the process relates to allocating the transaction price. So to the extent that you do not have multiple performance obligations in your contracts or revenue streams, then somewhat evident there will not be an allocation process. Whatever the fixed transaction price is will relate directly to the single performance obligation. In my example of the museum that has the 3 performance obligations I spoke about, it has to be an allocation of the transaction price. So assume the transaction price in that situation is $100 for the annual membership. The standard prescribes that the allocation be based upon the relative standalone selling price. So what that means is you try to identify the best you can, if you do, what you sell or offer the individual performance obligations for. So if it's just a standalone membership without the newsletter, without the parking, what that price is. If it's just the newsletter, what is that price? And then at that point, it's somewhat of a mathematical exercise in calculating the relative standalone selling prices and allocating it on a pro rata basis to what your actual transaction price is of $100. So now we've been through, I'll say, all the hard work of analyzing the revenue streams and the contracts. We're now at the point where at step 5 of the process, we're ready to recognize revenue. So revenue is recognized when or as each performance obligation is satisfied. And the third bubble there's really 2 alternatives to recognizing revenue. It's either recognizing it at a point in time or recognizing it over time. The default in the standard is that you first are required to look to see whether you should be recognizing the revenue over time. And to recognize it over time means that the customer or the member that I spoke about concurrently receives and consumes benefits provided. So an example of a membership example, the access to the museum, that performance obligation, I think everybody probably would agree that the member is receiving and consuming benefits over the entire period of the membership. So for that performance obligation, you would recognize the revenue over the period of the membership or the subscription. So if you don't qualify for recognizing revenue over time, then you will recognize the revenue at a point in time. So point in time indicators include when legal title is transferred to the customer, to the member in this example, and or physical possession has been transferred. So this would relate to the publication newsletter portion of the membership that I spoke about in my example. So when you disseminate the publication by electronic means, or perhaps if you're mailing it, at that point in time when you are distributing it, that would be when you're satisfying the performance obligation, and you would recognize revenue relating to that particular publication. So rather simplistic examples, but hopefully you get a feel for the differences between those 2 methods of revenue recognition. Again, I know it's rather a quick look through the 5 elements, but you know, unfortunately we don't have time to do a deeper dive. The last component of the new revenue recognition standard relates to disclosures. They are enhanced, expanded disclosures required with the new standard. And you can see here on the slide that there's 6 points mentioned. And in lieu of going through every one in detail, what I will say is that if you are not a public entity, there is some relief for you, and that doesn't mean you don't have to have additional disclosures. It means you can have some more condensed disclosures. If you are a public entity and you have conduit debt, then you'll have to have all of the expanded disclosures. And so that'll be something, whether you're a public entity or not a public entity, you will have some additional disclosures in your financial statements upon implementation of the new revenue recognition standard. So from a transition perspective, there's really 2 ways to adopt the implementation. One is what they call the full retrospective method. And essentially what that means is if you have comparative statements, for example, 2018 and 2019, you would need to go back and restate your net assets as of, say, January 1st, 2018, so essentially back for 2 years. The simplified method, which is what I think most organizations will elect to do, really only requires you to go back to the beginning of the current year. So in the 2018-2019 situation, you only have to go back to January 1st, 2019 and restate your beginning net assets. So it's essentially a 1-year look back instead of a 2-year look back. So, now that you've heard all this, kind of what to do next, if you haven't already had a chance to begin the process, certainly recommend that you consider establishing a cross-functional team of, accounting and finance members in your organization and maybe some programmatic folks. Certainly talk to your accounting experts, your CPA firm. Understand all the revenue streams and contracts that you have. Point number 4, try to put together a pro forma analysis of what you think the impact is going to be. And then to the extent that there is going to be any significant impact, then certainly encourage you to communicate to your board of directors, your audit finance committees, what those changes are going to be. And if it's kind of so significant that you think there's going to be any impact to any loan covenants that you might have, then certainly encourage you to discuss things with your bank. One thing that I failed to mention earlier with regard to the membership example, and maybe one opportunity for strategy, is to the extent that, say, your membership period is an annual period and that coincides with your fiscal period, say it's a calendar year, then this will all kind of take care of itself through the course of the calendar year. It's only where you might have some overlap between years that this may cause some problems in terms of timing of revenue recognition in the new model compared to the current model. So something to think about potentially from a strategy perspective. There are a couple of examples here that we don't have time to go through, but certainly would encourage you to review at your leisure. The one example is an example of an education advocacy membership. It's kind of along the lines of what I just spoke about within my presentation of the museum example. And then there is another example, example B, pertaining to tuition and fees in a hypothetical college situation. So even if you're not a college, but say you're a private school of some sort, a daycare, this example will provide some insight with regard to how to handle and think about tuition and fees. And certainly, we'll have a Q&A session at the end and encourage you to put questions into the queue as we go. So the second part of my presentation relates to ASC 842, the new accounting for leases. So at a high level, the impact is going to be that there's going to be more assets and liabilities on your financial statements. So there could be an impact on debt covenants, financial ratios, and other types of compliance ratios. When does this happen? It happens 1 year after the revenue recognition. So for non-public entities, you're looking at calendar year December 31st, 2020, or if you're a fiscal year June 31st, 2021. All leases are subject to the new guidance, except for if you have leases at their commencement date or of a duration of 12 months or less,
you have the ability to not apply the new lease accounting to those short-term leases. Here's a good kind of snapshot comparing the current accounting to what the new accounting is going to be. So in the middle column for previous, I think as most of you are familiar, we have capital and operating leases today. Capital leases are on the balance sheet, operating leases are not on the balance sheet. In the new accounting, we have what's called finance and operating leases. Finance lease is essentially the same thing as a capital lease, and really the accounting does not change. It's the operating lease, which you can see there in the middle line, is now going to be on the balance sheet. And so essentially, the new model prescribes that there will be no off-balance sheet accounting of leases, except for, as you see at the bottom of the slide, the exception for short-term leases, as I mentioned a minute ago. So the core principles of the new lease standard are you'll have a liability on your financial statements, on your statement of financial position for the amount of lease payments. So at the lease inception, you will calculate the net present value of the future cash payments that are to be made under a lease. You'll have a corresponding, what they call right to use asset, representing the rights to use the underlying asset for the lease term. And so the difference is that you have more assets, more liabilities on your balance sheet. And then the presentation is that for the income statement or your statement of activities, a capital lease will continue to recognize depreciation and interest expense, which is similar to the current capital lease model. And the operating expenses will recognize rent expense on a straight line basis. Here is a snapshot of what the comparison might look like between an operating and a financing lease. And the statement of activity impact may not be all that much different from what you're currently experiencing today. I think, again, the major impact is going to be on the statement of financial position, where you're going to have more asset, more liability. And the impact of having more liability could potentially have a negative impact on any covenants that you have with your bank that are related to liquidity or debt. So again, similar to the lease recognition standard, you're doing the same kind of thing in terms of identifying people in-house to undertake the implementation, updating your lease inventory, looking at the impact on debt covenants, and then as always, discussing with stakeholders such as your board of directors and bankers as needed. At this point, I'm going to turn it over to Amish, who's going to update us on the new accounting standard for contributions received and contributions made. Amish?
Thank you, Pat. Hello, everyone. I'm Amish Mehta, partner and nonprofit practice leader at Friedman LLP, and I'll be speaking on the last topic in this webinar, which is the new accounting standard for contributions received and made. So this clarification came out as a result of the new revenue recognition standard that Pat Dugan just covered. So let's talk about what the overview of this new standard is. So if you look at the current slide in front of you, we'll talk a little bit about the current practice. So when we think about exchange transactions, you have a couple of buckets that we have to consider. Is there direct commensurate value to the resource provider? So is there a quid pro quo? Is each party receiving an equal benefit? And are there specified third parties mentioned, or is it as the beneficiary, or is it the general public? So if you look at the clarification, as far as exchange transactions go, the accounting for the direct commensurate value of the resource provider doesn't change. It's the same exact accounting. So when you get into the specified third parties, there is a distinction that's made over here between whether it's a government or a resource provider is a third-party payer on behalf of an identified customer, or is it others, including groups of beneficiaries with eligibility criteria. So perfect examples of that are when you talk about payments on behalf of a customer, and the slide makes reference to it, patient service and tuition revenue. So when you think about patient service for a hospital or tuition and revenue for a student, the student or the patient is charged the full amount of that particular revenue stream. It is just the government is paying a portion of that revenue stream on behalf of that individual that is the direct beneficiary. We contradict that with a group of beneficiaries. So for example, if you think about an example of a homeless shelter, the government contracts with the not-for-profit as the entity that's going to provide the benefit to the general public, which has to meet certain eligibility criteria to receive that benefit. So in that case, the clarification that's made is that that would fall into contribution accounting. Historically, when we've talked about exchange transactions, we have had a tendency, or at least the prevailing view has been, and even though there have been variances in practice, that government grants and contracts have typically been treated as exchange transactions. Going forward, as a result of the new ASU that Pat talked about, more of those transactions are likely to fall under the contribution model. So a couple of key points to keep in mind when we think about what is considered to be a third-party beneficiary versus a primary beneficiary. So going forward, the resource provider is not synonymous with the general public, and even if it's a government entity. If the resource provider receives value indirectly by providing societal benefit, that would be considered a non-reciprocal transaction subject to contribution accounting. If the primary beneficiary of a granted contract is a third party, the not-for-profit has to use judgment to determine if the transaction is reciprocal or non-reciprocal. Furthering a resource provider's mission or feel-good sentiment does not constitute commensurate value received. And the type of the resource provider should not override the substance of the transaction. So whether it's a government entity, a private foundation, we need to look at the substance of the transaction to make that determination. Another concept that the ASU introduces is this notion of a barrier. So we have a slide on the next slide has a nice decision-making tree that'll give further clarification to what is the definition of a barrier. So let's look at the decision tree that we go through in order for not-for-profit to recognize revenue. So the first bubble in the upper left-hand corner, is it a transaction in which each party receives commensurate value, right, equal benefit? If the answer is yes, you would defer to the revenue recognition standard that Pat Dugan went through, and specifically the 5-step model. If the answer is no, and it's a non-reciprocal transaction, we would apply the contribution or non-exchange guide. The next determination that you have to make is, are there conditions present? I.e., is there a right of return? Is there a release? Is there a barrier? And we'll talk a little bit more about the barriers, and we have several examples that go through, that walk us through this model. If the answer is yes, then it's conditional contribution, and you would recognize the revenue when the condition is met. If the answer is no, and that there are no conditions present, the next determination that we have to make is it with restrictions or without restrictions? If there are no restrictions, then we would be unconditional and without restrictions, and therefore it would be unrestricted. If there are restrictions, then it would be unconditional, but with donor restrictions. In terms of the effective date, it's very similar to the time frame that Pat Dugan referred to for public entities, as Pat discussed, a slightly earlier time frame. And for all other entities, typically it would be for calendar year 2019 or fiscal 2020. The accounting for resource providers, the party on the other end, the accounting is exactly the same, although we have slightly different adoption periods. So let's walk through some examples to make some of the concepts in this ASU clearer. First example is a grant from the federal government. The university is awarded a grant from the federal government. The agreement requires the university follows rules and regulations established by the OMB, incurs certain expenses or costs in compliance with regulations established by OMB, obtain an annual audit, and submit a summary of the research findings. Any unused assets are forfeited, and any unallowed costs that have been drawn down by the university are required to be refunded. And here's a key concept. The university retains the right to the findings. So the question that we would ask is, do we have commensurate value? And the answer typically would be no. So is this transaction an exchange transaction or non-exchange? The answer is non-exchange. As I mentioned earlier, we don't have commensurate value being exchanged between the two parties. The university is the one that's retaining the right, so all the research findings, and receives the primary benefit of the findings. The federal government's benefit is considered indirect because the research and findings serve the general public. Let's look at another example where you have a grant from a local government. The not-for-profit receives funding from the local government to perform research study on the benefits of a longer school year. The agreement requires NFPC to plan the study, perform the research, and summarize and submit the research to the local government. The local government retains all rights to the study. Again, do we have commensurate value? And the answer is yes, because in this case, the entity providing the funds is the one that's going to retain the right to the study. Is this transaction exchange or non-exchange? The answer is, if this is an exchange transaction, as I mentioned before, we have commensurate value that's being exchanged between the two parties, and the local government retains the right to the study on the benefits of the longer school year. Another example that, and Pat referred to this in his example as well, is when you have a university that pays tuition or provides tuition on behalf of a student to the university. For this example, there is absolutely no change in accounting. The revenue is accounted for as without donor restrictions. Once the student has met the performance obligation, once the university has met the performance obligation of providing tuition and education to the individual, the third-party payment that's being made, as I mentioned, is strictly on behalf of an individual and not for the general public or the benefit of the public. So you have other transactions on behalf of specified third parties. So you have a social service organizations that provides drug rehab services to individuals. Individuals sign up for the service with payment made for services made under a local government contract. Typically, we would treat that as a non-exchange transaction subject to contribution accounting. The other example is when you have an affordable housing entity that receives some kind of government subsidies on behalf of individual residents. There again would be payments being made on behalf of other entities, and then you would provide the exchange guidance, which is the items that Pat Dugan covered. Let's give a few examples of what we mean by barriers. So you have a barrier or grant from a private foundation. And in this example, if you look at the second bullet, there are specific minimum targets that must be met each quarter. If you look at some of the other criteria, they're more of generic criteria and not really consider what we would consider to be barriers. So this is a non-exchange transaction, but is it conditional or unconditional? The not-for-profit determines that this grant should be accounted for as conditional. If you look at what some of the criteria are, it gives you a specific level of service in terms of the amount of minimum veterans that need to be trained on which the entitlement depends. The grant agreement also contains a right of release from an obligation, and the likelihood of serving those minimums is not considered remote. So in the past, one of the assessments that we would make is what's the likelihood of not meeting that condition. We don't use that criteria going forward in this ASU. You've got to defer to the other criteria in the grant and contract agreement as the driving forces in terms of determining whether it's conditional or unconditional. The next example talks about the best effort metrics, right? So when you look at the example that you have in front of you, and specifically focusing on the second bullet point, the stipulation is that as long as the funds are used towards the tennis program. So is this grant conditional or unconditional? The not-for-profit would determine that this grant is unconditional because you don't have a barrier to overcome for the not-for-profit to be entitled to the transferred assets. The grant does not specify that entitlement to the transferred assets and is dependent upon meeting any of the stipulations. And because the stipulations in the grant agreement were not required to be met or entitled to the funding, the agreement does not contain a barrier to overcome. Next example has to do with the museum that receives $1 million grant from a corporate foundation for a new wing. If you look at the bullet points that we have in front of us, there are specific criteria and hurdles that have to be met in order for the museum to receive the funding. Given that, the specificity of the different criteria, the museum would determine that this grant agreement is conditional. You've got to meet the LEED certification in order for the resource provider to release the obligations. There are clearly multiple criteria that have to be met. Again, the likelihood of whether the not-for-profit can meet the criteria or not is not considered an exam or consideration in determining whether something is conditional or non-conditional. In the next example, we have, again, various criteria from grants and from a federal government. If you look at the various criteria here, the only one that is key here is the second bullet point, which refers to meeting qualifying expenses in order to recognize revenue. So we previously determined that this transaction is a non-exchange transaction, so we follow the contribution criteria. Is it conditional or unconditional? And this would be considered conditional because in order to receive money from the government, you've got to meet the qualifying expense criteria. So you would recognize revenue to the extent that you had qualifying expenses. You get to the same conclusion that we did under previous accounting, just the terminology has changed. What about the limited discretion example, grant from a corporate foundation? Similarly, you have a not-for-profit that works with gluten-related allergies as part of its overall mission. It applies for a $100,000 grant from the corporate foundation to perform research. The grant includes right of return. The approval must be obtained from a corporate foundation or any significant deviations in spending from the general budget, and a requirement that there must be a grant report provided. Again, this is a non-exchange transaction subject to contribution accounting. Is it conditional or unconditional? And the not-for-profit determines that this is unconditional. All of the criteria that's laid out in the grant agreement are fairly straightforward and fairly common in grant agreements and not deemed to be barriers. However, it is a restricted grant because it's specifically limited to working on gluten-related allergies, and therefore the not-for-profit will account for it as with donor restrictions. In the next example, you have a not-for-profit that received a pledge over multiple years. Year one, it's payable up front, no associated conditions, and the other 2 years have conditions associated with it. When would the university recognize this pledge? The university would bifurcate this transaction. The first payment is not having any conditions. Therefore, the university would immediately recognize a $7 million payment without donor restrictions. The other two payments have certain barriers that are associated with it. So the not-for-profit would recognize those two payments depending on when those restrictions have been met. The scheduled payment dates, however, do not determine the timing of recognition. As I mentioned, the meeting of the conditions do. Let's spend a minute talking about the simultaneous release option. So the not-for-profit, historically, we've had this option where if a not-for-profit received funding from a donor, and the not-for-profit will be able to meet the restriction within the same period, it had an option to elect the simultaneous release option. So therefore, the not-for-profit would recognize that donor restricted revenue in unrestricted, and then and the expenses would have been recognized in the unrestricted bucket rather than initially recognizing it as temporarily restricted and then releasing it the whole amount in the same year. Now we can divvy up that election. So you have the ability to, for example, recognize government grants one way. So, for example, you can recognize them as with donor restrictions and then release them from restriction. And then if you have private foundation money, you can also recognize that under the without donor restriction bucket. So it does give you a flexibility, as my colleague Denise mentioned. We don't no longer have an all or nothing scenario that we previously did. And we have a quick example to walk that through. A not-for-profit runs a shelter. It's awarded a matching grant for a one-to-one match. And the chart gives a progress on the grant. So the not-for-profit has elected the simultaneous release option only for those restricted amounts that were initially conditional. Does this grant qualify for that bucket? And in this example, the not-for-profit determines that the grant does qualify for that bucket for the various bullet points that are listed on the side. And again, the grant award date isn't what's relevant here. What's relevant is the date on which the revenue was recognized, and i.e. the date on which the condition was met. So I know we've covered a lot of material in this webinar, and then now we're going to open it up to the Q&A portion of the webinar. Great. I'm glad to see that we captured most of the audience throughout the presentation, so I'm glad everyone stayed with us. We have a few questions that have come through for the panel, and I'll just read out the questions and then let the panel member answer the question for the topic that it relates to the area that they covered. So we have the first question for Pat Dugan. Other than examples you mentioned regarding memberships and tuition, what do you think are likely to be other revenue streams that could have implementation challenges?
So, thanks, Amish. It's a great question. I think, you know, as I think about that and think about this with the nonprofit sector, the distinguishment between grants and contributions and determining whether you are or not in the ASC 606 revenue recognition arena, I think, you know, can be challenging. So I think Amish, his presentation provided a lot of good insight on, you know, helping make that determination. So a lot to think about there. To the extent you have multiple performance obligations, so whether it's the example I went through with the museum and having publications and museum access, or even if it's special events where you've got part contribution, part exchange, you need to think about whether your transaction and agreements have multiple performance obligations. If they do, you need to allocate the transaction price accordingly. The final area I would say is, you know, if you're in the nonprofit healthcare space, you will need to, on the front end of the transaction, estimate what you ultimately expect to collect. So it's a variable consideration concept, and that's something that, you know, may be a little bit different in terms of process than what you're currently seeing today.
Great. The next question for Denise, where can we get examples of financial statements where the new NFP financial reporting and disclosures have been adopted?
Sure. So I would suggest if you would like to get examples that you can reach out to me. My contact information is on the screen right now. Myself, Amish, Pat, and we'll be happy to email you examples and answer any questions that you might have.
Great. Next question falls under my umbrella, and that's, does ASU 2018-08 require a probability assessment whether it is likely a recipient nonprofit will fulfill the stipulations in evaluating conditional versus unconditional contributions? And you may recall from my presentation that no longer is the case. We used to make that determination, what is the likelihood of meeting a condition or not, in terms of whether we determine to be a conditional or unconditional contribution. That is no longer the case. The likelihood of meeting the condition is irrelevant going forward. Next question is another, you know, where can we get the examples? So where can we get the slides for the presentation today, Denise?
A copy of this presentation will become available on our website within the next day or so to be able to view this again. In addition, slides can be available by reaching out to us via email at the end of this presentation.
Next question for Pat. To what extent is Friedman able to assist with revenue recognition / leases implementation?
So we are, the good news is, you know, we are able to assist. I mean, there's, you know, current clients listening in. We can assist you with the implementation. We do need to be cognizant of, you know, maintaining our independence, which is usually not a problem, just means that our clients need to assume responsibility and need to make decisions. But with respect to revenue recognition, we do have a proprietary kind of decision template we've developed, which, you know, is probably best if we, you know, kind of share that with, you know, clients, and there's non-clients interested on a one-on-one basis, just to kind of provide a little more education with that. And with respect to leases, there's also a template that will assist with some calculations. And again, if you need help with that, you know, please feel free to reach out to your Friedman service professional.
Next question relates to my area, and that is, does ASU 2018-08 require a restatement of prior amounts recognized in the financial statements? So if you're going to be presenting comparative financial statements, you do not need to restate the prior year numbers. You're going to recognize the new revenue stream in the current year that you are presenting. So for example, if you have a 5-year grant, let's say now you're going to be entering year 3 of the grant, you don't go back and change the year 1 and 2 accounting. You recognize the year 3 under the new standard. We have another question that came in. How and when should we recognize revenue on a challenge grant where the grantor will match other fundraising donations up to $100,000?
My recommendation would be, so it's a challenge grant, meaning that they will match dollar for dollar whatever the criteria might be, outside new donors, existing donors, so that recognition should match as those matching contributions come in. So as 10,000 comes in, you recognize 10,000 of the challenge grant, and so on and so forth until you've met the $100,000.
Yeah, one of the things that I may have mentioned throughout my presentation is that this new ASU, for most of the times, the accounting will stay the same. It's really the path that you take to reach your final conclusion that will change. So, in the question that was just asked, the accounting was the same as before. Really, nothing has changed from that perspective, except a lot of the terminology. So again, I want, on behalf of Denise, Pat, and myself, we want to thank everyone for joining us on the webinar today. As we mentioned previously, if you have any questions or we can be of any further assistance, please don't hesitate to reach out to us. We will send out follow-up emails, so you'll be able to give feedback on the webinar. I believe we'll have a survey as well, so that you can provide feedback not only on this webinar and the topics, but anything else that you would like to see in future webinars and seminars and topics of interest that might be of interest to you. So again, once again, thank you, and we look forward to hearing from you, and hopefully you'll join us on our future webinars.